Ladies and gentlemen, in a shocking article that just came out, the Business Times columnist has actually encouraged the three local banks to cut their dividends rate. And this is a shocking news because many of us love the local banks for their high capital gain and high dividends. And if their dividends are now impacted, there's a good chance that our retirement plans might be affected as well. So what's the implication of this and how does outlook look in Singapore? Let's just watch on, shall we?
Okay.
All right. Okay.
The chairs are gone.
Hey, this is a munchkin.
This is a munchkin.
It's a munchkin. So in the article, it is encouraged that DBS, OCBC, and UOB to cut the dividends. And I will quote the columnist: "The sunny skies might not last much longer," and that's quite serious. So these are my usual disclaimer, not telling you to buy or sell or anything. This is not financial advice, and let's go. So the three local banks, UOB, OCBC, and DBS, has been the darling of the Singapore stock market for many years. Everybody loves them for their capital gains and their dividends. And many retirees actually use these three banks for high capital gains, to fund their future retirement needs and also the dividends for daily expenditures. But it seems like there's a chance that good days are likely to come to an end. So remember, hit subscribe for development in this space, as the outlook is very volatile and change is very likely to hit this space. So the Business Times in an article today actually entitled "DBS, OCBC, and UOB should review dividend policies amidst the deteriorating business outlook." That's quite serious, right? So just to take a quick look, some people think that our three local banks are invincible. You will never see the three local banks fall in either dividends or in capital gains whatsoever. That's obviously not true. When the day it was announced that there was a trade war and the stock market really dived. In the case of OCBC, which I have got a few stocks, not a lot, just a few stocks, it has dived from somewhere around $17 over all the way to 14 plus. Okay, and fortunately, in one weekend they flipped, especially when we talk about the China-US trade war, and then we now see some form of recovery. The next bank is UOB, exactly the same trajectory as well, deep dive and then recovery as well. DBS also seeing the same trajectory, doing well, deep dive, recovery. So it is not true that these banks are invincible. It is true that these three banks are highly protected by MAS, and that's why foreign competition cannot come in and invade their space. And this is a very unusual kind of artificial wall that's protecting them. So in the article, is basically say this, it's probably will not surprise anyone that DBS, OCBC, and UOB end up significantly higher after US and China agreed over the long weekend to temporarily slash the crippling tariff that they slapped on each other. So trade war was a reason why the whole bank stocks went down, and then the ceasefire caused the stocks to go up. But however, this is a very important part of the article. Okay, profitability at the three banks could be adversely affected by weak loans growth as economic activity slows. So the first premise is that there is most likely some form of an economic slowdown in Singapore. And the second thing is there's a sharper than expected contraction in net interest margin as interest rate fall. So these three banks are the darling of Singaporeans. Most of us have owned some stocks of it. Okay, I do have some OCBC, I said, but I'm sure a lot of you have DBS and UOB as well. So net interest margin basically is easy to see what it is. You just take a look at the formula. Net interest margin is equal to interest income minus interest expense. So basically, the banks take in money from depositors, or they borrow money from someone else, okay, and then lends it out, okay, and have a difference, right? And you take, so this is how this is basically their profit, okay, this is their profit. And they divide this by average interest earning asset, okay, times 100%. So this is what net interest margin is. Basically, is a measure of how much I can take advantage of the deposits that are put with me or money that put in me, So it's basically a measure of a difference in interest rate that I borrow versus I lend out. That's all. As simple as that. So if a bank earns $5 million in interest income and then pays $2 million in interest expense and has $100 million in interest earning assets, so it's a NIM, which is a net interest margin, is 3%. So it basically makes 3% from it. So in the event where there is an increase in interest rate, you will see the NIM goes up significantly because it can lend out a hell of money. And given that UOB, OCBC, and DBS got a hell of money, they could make a lot of money from the interest. Now, interest rise because of the high inflation environment is very abnormal. So right now, we all know the interest rate is coming down. You just take a look at our latest T-bills is just hardly slightly above 2% only. Right? It came down significantly from a high of 4%. So interest rate is coming down. Federal Reserve is cutting interest rate potentially by 2 times this year as well. So we're going to see interest rate coming down almost a certainty. So in Q1 2025, net interest margin weakened across 3 banks. OCBC was hit the hardest. Unfortunately, I do have a few lots of OCBC. Fortunately, I bought them at $5. Now it's about 16 plus, still a 3 over times increase. So Q1 2025 NIM comes at 2.04% versus 2.15% in Q4 and 2.27% in 2024. So it has came down quite significantly. The NIMs at the 3 banks have widened between 1.45% and 1.56% in 2021 to between 2.09 to 2.28% as interest rate rise in 2023. So basically, the rise in interest rate allows them to make a hell of money from interest differential between what they borrow and what they lend out. And now the interest rate is stabilizing and softened. The gap is now narrow. So they now make a lot less money right now. And with the interest income at 3 banks facing headwinds, investors have drawn optimism from the strength of their non-interest income, which is basically means that the banks don't just lend out money, they make money from other places. They do trading income, they have got credit card and wealth management services and all this. But these are peripheral businesses, which tends to be volatile and hard to forecast. And those fees-related services are also susceptible to competition. So, in those premium banking services whatsoever, you have got Barclays, Nomura, and a lot of guys all coming in to compete with them. So their real moat, their real protection from the MAS is really lending and borrowing. So this one, is going to be hit. So despite the relatively strong non-interest income, the return on equity of 3 banks began to plateau and fall last year. For example, the DBS ROE flattened out at 18% in 2023 and 2024, up from 15% at 2022. So OCBC reported ROE of 13.7%, up from 11.1%. So return on equity has been strong, but it's plateauing, right? So in 2025 Q1, all of them reported low ROEs. So UOB ROE rose to 13% and start coming down already. So return on equity is all coming down. And for understanding what return on equity is, basically every dollar that the investor put into a bank, how much money they can make out of it, right? So that's return on equity, and if they can make less and less, we should expect the stock not to perform as well. So while the risk to profitability at DBS, OCBC, and UOB are growing, the 3 banks have held the attention of investors by putting increasing amount of cash into their pockets through dividends and share buyback, which basically means that the banks are trying to make their investors happy by giving you more and more dividends and share buyback and things like that. However, I don't think the bank can do this forever. If their profits are going to fall, how are they going to fund all these dividends and share buyback, right? Now, the banks are not stupid. So what the banks did was that they have set aside some allowance to their buffers in case potential loan losses triggered by the trade war. And the trade war is not over. The trade war is is de-escalating, but it is something that is still uncertain. So the banks just want to be careful, and I think that's prudent and wise to do that. So meanwhile, let's also look at what's happening across the world. There is a lot of layoffs that are now happening. Now, we don't know whether the world will go into a recession, but slowdown is a current phenomenon now. And with the slowdown, we now have got serious retrenchment exercise. So we have got, in the tech space, we've got Microsoft just announced that lay off 6,000 workers. And then we have Meta, Intel, Dell, Electronic Arts, Ubisoft, all of them announcing some significant layoffs. In the logistics sector, we have got UPS, Panasonic, and Boeing all announcing some layoffs. In the retail space, Burberry, which brand is not doing very well right now, Estee Lauder, Forever 21, all going down. Banking space, the HSBC announced some big cuts as well, and plus some other banks as well. So we see now layoffs is the trend, and it's no longer focused on one sector, it's all across the whole sector. We don't know whether this is going to be different when after this trade war ceasefire between US and China. But we do see that this is going to happen. This is happening in a big way and potentially going to happen in other parts of the world as well. So what's my take on this situation? Okay, number one, which I always stress, is that over-dependence on one or two asset class is always risky. Try not to be over-dependent on one asset class or the local banks, all in on property, all in on even S&P fund and NASDAQ. All these are very dangerous. The astronomical rise of local banks in the past few years is an abnormality, right? It should not be seen that this is going to continue in the long run. It's all really caused by the rise in interest rate, which now the inflation rate is falling and falling significantly. And therefore, eventually, we should see falling interest rate as well. This is imminent. This is going to happen. It's not a matter of if, it's a matter of when. With this whole thing, we also need to say that because the trade war is not over, and the trade war only means that it is not as serious as we thought it is. But right now, we do have a 10% baseline and potentially some other trade war impact as well. So Singapore is still likely going to experience some slower growth. Most likely, we will avoid a recession, but the slower growth will still happen. So the rosy banking outlook, that we have seen, for the past few years, I think the good days are probably over. So let me emphasize, this classic 101 that we have in investment theory is that we should always diversify. Unless you're as good as Warren Buffett, then you don't need to diversify. But if you're not, then we better diversify. Put some money in the CPF, some money in special account, some money in bonds, some money in stocks, some money in property, some money in other asset classes, businesses, whatsoever. Just spread it all out. So I'll be watching this space very closely, reading all the macroeconomic signals, especially in Singapore, because this is no longer about seeing investment opportunity. This is trying to identify would there be some kind of a storm, or at least some strong winds are going to hit us, because all these things that are happening in Singapore will affect job security, will affect pay, stability, will affect properties, will affect banks, as you can see right now, and our local economy. So watch this space very closely and hit subscribe so that I can inform you real time, a lot of times in live stream, and I'll see whether tonight I'll find a chance to do live stream for you guys. But let's just watch this space very closely. Thank you for watching, and I'll see you in a day or two. Bye-bye. All right, guys. I don't know whether you know, but Mr. Lu has a few cats, but nothing beats having a cat-fed cafe with 50 cats inside. So I'm here actually to do my video recording, but oh, you're so cute. Okay. All right. Let me show you what this place. Just look at that. So many cats. Oh, you're so sleepy. Hey boy, how are you doing? How are you? Oh, this is a Persian. Alright, something like a Persian. Chu Chu Lian.
Oh, wow, you got blue eyes, man.
They're all looking at you now.
You got blue eyes. It's a really cool blue eyes that you have.
All right, boy. You're looking for food. Oh, suddenly got so many of them. Hello there. How are you? Looking for food, right? Oh man, I've got so many here. So how am I gonna work in a situation like this? Meow. Meow. You know I can't work when you're on my computer. Oh my goodness. You come too? Meow. Right guys, you know I've got a computer. You're not supposed to come onto my computer, if not I cannot work. You know that, right? Okay? Hey boy, you know I can't work this way, right? You cannot just come to my Mac and then expect me to do work.
Mr. Lu is doing his recording, and then there's a lot of cats around.
There's one here.
So